we're not just a real estate operations company. We also have a marketing company to find those real estate deal flows, and then also a capital raising and investor relations company to find the investors and to service those investors. So that was a huge turning point for us, is when we started treating the company as three separate companies and building out the processes and procedures that allowed us to scale to where we are in such a short time.
Pretty impressive.
Welcome to the Property Podcast, where great minds in real estate get together.
Welcome back to the show. I'm your host, Angelina, and today we're diving into a niche that many overlook, but our guest has turned into a powerhouse. He is the self-storage renaissance man, a senior managing partner across multiple firms, including SSE and Impact Self-Storage. And he's currently overseeing over $240 million in self-storage investment. And please welcome Fernando Angelucci.
Thanks for having me, Angelina.
Of course. So let's dive in. Fernando, you've built an incredible portfolio. Looking back at your journey, what was the specific mission-critical decision that allowed to scale to $250 million in assets?
Yeah, I think number one is making sure that I'm in the right space, asset class. So we have had many businesses before this focusing on smaller real estate transactions, single family homes, small multifamily, hard money loans, Airbnbs. And what we found is that every time we added a zero to the equity, every time we added a zero to the debt, things got easier. And with that higher scale, we were able to raise more cap. So number one was choosing the right asset class, choosing deals that are large enough. The second thing is treating our business as three separate businesses. We're not just a real estate operations company. We also have a marketing company to find those real estate deal flows, and then also a capital raising and investor relations company to find the investors and to service those investors. So that was a huge turning point for us, is when we started treating the company as three separate companies and building out the processes and procedures that allowed us to scale to where we are in such a short time.
Pretty impressive. So your focus is on emerging growth markets. So why has this under the radar strategy been your secret to consistent growth without the usual risks?
Yeah, so number one, the marketing side of our business, we want to make sure that we're buying these assets and locking in our profits at purchase, which means that we need to buy assets typically below market value. And to do that, we need to create a direct to seller strategy. Using real estate brokers is like going to an auction house that has 1,000 people bidding, and you're trying to bid on that one item with the other 1,000 people. When you go direct to seller strategy, typically you're the only one bidding on that property, maybe one of a handful. And because we have a solid track record and the creative ways of structuring our deals, we can usually win out. So over the last 6-7 years, about 90+% of our deal flow has come from direct to seller strategies. And that allows us to lock in profits on value add properties in markets that either may be overlooked or on assets that may be overlooked in hot markets.
Interesting. So you recently spoke about how innovation can add complexity and management costs can eat returns. So as you scale even further, how are you dealing with the noise of managing ancillary services without losing your return of investment?
Yeah, so number one is focusing on the things that bring the highest ROI for our investors. We are an asset and acquisition company. We are not a property management company. So what we do is we will hire third-party property management companies that's all they specialize in. We put guardrails on them, and then they do the kind of day-to-day management. But where we make the majority of our profit is from acquiring the right properties at the right price with the correct structure for the debt and equity. And that is the part where we excel, and we make sure to put all of our effort into those parts of the business and allow basically the professionals that do property management every day to handle their side. Now, that being said, over the last 2 years, roughly, we've had this phenomenal increase in productivity due to artificial intelligence, basically permeating across every one of the vendors that we use on a daily basis, whether it be database management, marketing, operations management, revenue management, investor relations, report building, and quarterly updates, as well as, tax and K-1 documents for our investors. The efficiency and effectiveness of each one of our employees has gone through the roof over the last 2 years and significantly over the last, I'd say, 6 months.
Because of all the technology available out there.
Right.
And what about the property management side of it? Is your property manager company using AI, or have you ever thought about having an automation like property management and autopilot?
Correct. So we do implement these types of softwares. For example, there is a service that we use that not only does it actively check all of our competitors' rates, it also checks activity from searches on Google in our areas. And if it sees a spike in search for, let's say, self-storage in Chicago inside of our submarket, it will start increasing rents. So dynamic pricing from the front end. It also has the option of doing dynamic pricing from existing tenant or existing customer rental increases. So for example, it'll go through our entire rent roll and it will say, it'll score all of our existing customers from 1 to 10. Customers that, let's say, pay in cash and are constantly late, it will acknowledge that these customers most likely will not absorb a rent increase, so we'll score them low, 1, 2, 3. On the flip side, let's say it sees that there is customers that are paying with an Amex Platinum card and it's auto paid every month. And at the same time, that customer is posting on open social media profiles that they're traveling first class or they're in Europe for the summer. This person is most likely not going to even see a rental increase on their credit card statement. So most likely will be scored a 8 or 9 or a 10. And then the system will assign how much to increase those individual customers' rent amounts on a monthly basis based on the number scoring. So some people might get no increase. Some people might actually get a decrease in rent versus those that score an 8, 9, or 10 may get, 16, 20, 25% increase in the rental rate, depending on what the system thinks makes sense.
So you really have like an AI stalker.
Yeah, exactly. Correct.
Which analyzes consumer behavior and consumer lifestyle.
It's crazy how much information people put about their personal lives on the internet. And just assume that it is just their friends looking at it. Now, with the ability to build AI agents and web crawlers, that information is not safe. And I would recommend most people to set all of their social media accounts to private unless it's purposely a curated professional account, because that information can be used when building a customer profile about you and whether or not you will increase, you can absorb increased rents on a month-to-month basis.
That is crazy, but it's actually good, let me tell you. So Tell me something, with $240 million in assets under management, how much time your team spent simply cleaning data, or do you also, implement AI on that area?
Yeah, so it's a combination of both. So, we, like I said before, we like to hire professionals that are, that's all they focus on is that one segment of the business for us. So data is not a big piece of our day-to-day time because those vendors are already taking over that piece of the business. And then they themselves are implementing AI and automation softwares inside of their tech stack and then producing those numbers or those data sets for us. I'd say where we have the most day-to-day interaction with data sets would be on the marketing side of our business, getting the deal flow in-house. And that side is not very complicated. Our use of AI is limited on that piece, but we still do use it. It does save us some extra time.
Interesting. Would you consider, like, in future, by the look of how things are going, would you see yourself managing a team of mainly just of AI assistants, AI managers? How would you feel about it?
Yeah, so it depends on which part of our business. So anything that's customer facing, I most likely would not implement at the current stage of competency in the AI agents and AI space. Our typical seller is typically an older self-storage owner. They want to talk to somebody live on the phone. They want to make sure that the person that they're talking to is familiar with the area, familiar with the asset class. So on the marketing side or anything that is customer facing, I'd say right now we are not ready to implement that. Now, that being said, if you look at where AI was 3-4 years ago versus where it is today, there's a lot of growth. Now, there can be arguments on whether that growth is going to continue or if there needs to be a fundamental change in how these LLMs are fed data, or even if it can get to a point where it's a hybrid generalized intelligence that can problem solve on the go. I just think right now for our industry, it doesn't really make sense outside of maybe some chatbots that are handling more, lower risk, lower stakes transactions.
So Tell me something. Coming from a technical system management background, you clearly value efficiency. Where do you see the biggest gap in the industry right now?
Yeah. So, real estate in general is a very inefficient market. So let's say, unlike the stock market where you have real-time data coming in via nanoseconds or microseconds, depending on what type of systems you're using, price discovery is pretty quick. And there is no ability to arbitrage, or there's a small ability, but it's a very small arbitrage. Whereas, let's say in real estate, illiquid asset, the data collection, the accuracy of the data may not be at the level to create a hyper efficient market. That's where we make a lot of arbitrage. We can buy properties, sometimes 30% below what we think they're worth today, and then increase the value of those properties before selling them in 3 to 4 years. So I think there is, a case to be had for these more legacy-based businesses where there's a trust gap, where you need to use third parties to build that trust. Real estate's a perfect example. You usually need to use a title company to prove that the seller actually owns the property. You need to have a lender with a commitment letter to prove that the buyer has the ability to get that deal financed. And where I see a lot of opportunity is actually on the blockchain. If we can get real estate records onto the blockchain so that there is a distributed network that shows all of the ownership history from the past, current, and then into the future, you can close that trust gap and thus remove those middlemen that give that trust, therefore making it a more efficient market, and then thus reducing the cost of the transaction. You see it right now on when you go trade stocks. 20 years ago, 30 years ago, you'd have to pay a broker per trade to trade that stock for you. Now, most systems that you use, it's free to trade stocks because they're making their money in other locations, and because of the speed of the data and the implementation, there's no need to call a middleman to do that for you. So real estate is still a laggard in that space where there's a huge trust gap. There a lot of middlemen are used. Title companies, survey companies, environmental companies. If all of that could be moved onto the blockchain, I think there'll be a huge push forward into the efficiency of the industry, and then also lowering those large transaction costs that are associated with illiquid assets.
That's great. If you were to give a piece of advice to your younger self, what would it be?
Yeah, go bigger earlier. I based on the books that I read when I was younger, starting when I was 16, I read Rich Dad, Poor Dad. I always thought that there was a progression that you had to do. You start with small investments, and then you take the profits of small investments to do a slightly larger investment, to then go do a slightly larger investment. And that's just not the real world. You can jump into much larger investments much faster. Obviously, you'll have to put a team around you and share in that profit. But I would rather take, 10% of a $100 million deal as opposed to getting 100% of a $100,000 deal, right? So scaling faster and earlier would be my advice to my younger self.
Yeah, that's so interesting because I just finished doing a podcast with another guest. He actually gave me the exact same answer. So it's unbelievable that the people that are thriving, they're thinking exactly the same way. So that's amazing. And thank you so much.